Well, good morning, everyone. I trust everyone's logged in and can see the screens, and we're ready to go. Welcome to the November edition. It's Andrew Kelleher here. Welcome to the November edition of the Select bi-monthly update. Actually, I haven't spoken to you guys for a little while via the webinar. We've had a few cameo appearances. And I actually think it was the last time I did the bi-monthly update, might have been back as far away as March. I'm not sure, but I certainly found one of the slides that we had in March, and that's, I think, the slide that we put up, the cartoon that we put up during March, when if you remember back, March was really probably the point of peak what I call peak COVID despair in what has been a truly remarkable year. I mean, we're not likely ever truly forget 2020, and it's hard when I look at that and I think back to what we were dealing with through February, through March into April, and now we stand at all-time highs on some share market indices. But it's been a funny old rally. It's been an uneven rally. Growth stocks have dominated 2020. We've had sort of strong cameos, I suppose I would call them, from some of these stay-at-home stocks, but now we're seeing quite a strong change over the last few weeks, and we're going to talk about that in a little while. So look, it's been a very strange year. Where are we now? Well, that's where we are now. Now that we're on this roller coaster on the share market, and since I was just looking at it in longer term, I mean, since 2018, we've had two reasonably material sell-offs, rebounds, and now we're faced with this prospect of we've had the recent news around the vaccine, and we now got a lot of people sitting around saying, are we going to move into a sort of a buy the rumor, sell the fact type event, or are we going into a are we going to a new era for share markets where they can, when we have a grand year in 2021, or are we staring at a sort of a repeat of 1994 in the bond market? We're seeing we're going to talk about a lot of those themes over the next 20 minutes. We might stray a little bit longer than 20 minutes. It has been known to happen before when I promise I'll only talk for 20 minutes, but I will do my best. So, I like to start by just quickly reviewing where markets have been, and this is a fairly frightening chart if you look at it. And when we put this one up last time, and that fairly dramatic drop that we saw. So we're looking at the NZX 50, we're looking at the ASX 200, the S&P 500, and the All Country World Index, the MSCI. I've put these back to 2007 to give us a bit of context. As you can see, since 2000, and certainly since 2015, 16, it has been, I think, dramatic is the way I would describe market movements. I have what I call normalized these, so I've put them all from a common starting point so you can see relative performances, and this is unhedged, so this is allowing for the impact of currency. And what it does tell you, I know we tend to focus on the New Zealand and the US share markets, particularly when we talk. Well, it's kind of not hard to see why when you look at this chart. The black line is the NZX 50 and the red line is the S&P 500, and you can see how dramatically their performance has differentiated from the global markets, which is the rather delightful. I mean, that's a sort of a cerise, isn't it? Is that right? Is that what you call that color? Let's just call it purpley pink. The green market is the Australian market, and some of the themes that we've talked about previously have sort of tend to show out here, and that's the underperformance, the relative underperformance that we've seen in the Australian market over the course of the last, certainly of the last 5 years. I would want to point out a couple of issues, and this is around and we have spoken about this before, and that's around, although we have that strong bounce back in New Zealand and in the US, it is pertinent to note that both of those indices have suffered from a sort of lack of breadth of performance. I mean, in New Zealand, we've seen a few stocks do extremely well, and in the US, we've seen the S&P 500, we've seen the FANG stocks and some of the tech stocks really dominate that index. They've also been the shares that have done very well. So it's been quite an uneven performance. So we've had a few stocks do very well in both of those indices. There is less of that effect in the Australian market, the market that's dominated by resources and banking stocks, neither of which we haven't seen any of those rock stars in those two areas. So you haven't seen that indices get the benefit of that lift. Now, just if we look right at the far right of that chart, not as pronounced on the black one, New Zealand market, but the US market, you can see how volatile the US market has been over the last few months, where we've had a sell-off, a rally back, a sell-off, and a rally back. And we'll see that a little bit more obviously when we look at the charts over the last year. If we take out the effect of the currency, if we hedge, if we look at what these markets are doing fully hedged, you can see that for a start, the US and the New Zealand market close up a little bit. That's due to the fact that one of the key themes of 2020, certainly recently, has been the strength of the New Zealand dollar. So that's adversely impacted holdings. If you look at unhedged holdings, when you hedge them, we take that effect out. We see those lines come together a little bit, and you see an improvement in performance in the Australian market as well, although we're still seeing quite divergent outcomes. And certainly what happens with currencies over the next year right now is a fascinating topic, and one which I will talk to a little bit more. Just looking at the last 12 months, you can see we're now very much in positive territory. This is the 12 months to the 18th of November in terms of the NZX 50. These are unhedged returns again. So New Zealand market looking quite special on that front. Again, the effect of the stronger New Zealand dollar depressing the returns we've got on the US, on unhedged US returns. But we're seeing a little bit of a close up there that between the global markets and the US market, and the Australian market actually in New Zealand dollar terms still struggling to get back into positive territory. Again, we take the effect of the currency out of that, and you can see that the global markets, the US market, New Zealand, they all close up a little bit as we remove the impact of the New Zealand dollar. So that's share markets. I do want to talk about interest rates, because interest rates are shaping up to be one of the really contentious issues over the rest of 2020 and into 2021. So the chart you're looking at here in the gold, sort of yellowy gold line, is the generic. It's a generic chart of the 10-year New Zealand government bond, and I've also got the 5-year swap rate. So what we're looking at here is we're looking at what we call the risk-free 10-year rate, being the gold line, and the black line being the swap rate, which sort of tends to drive the returns we're seeing on corporate bonds. So relevant for those core New Zealand fixed interest products that we have in the model portfolios. Now you'll see for a long period of time, this is going back to 2015, but from sort of 2018 onwards, those lines are very similar. What that reflects is we had a very flat yield curve. What we've seen more recently over 2020 is you're seeing some divergence there. What that signifies is we're seeing a steepening of the yield curve. So we're seeing primarily through 2020, we see the market saying interest rates are very low. They're going to remain very low for quite some time. So the shorter rates, 1 year, 2 year, 3 year, 4 year, are going to be very low. But we're not so sure further out. We think we might get inflation further out. We might see the removal of monetary policy accommodation further out. So you start to see the yield curve steepen up a little bit. So the 10-year rates are higher than the 5-year rates. What I do want you to note, though, what is most significant is what's happening on the far right of this chart. Right on the far right-hand side, as you can see, all of a sudden, that line goes almost perpendicular. This is as a result of what happened in the Reserve Bank's monetary policy statement released earlier in November. There'd been a lot of anticipation around the November monetary policy statement, primarily because we felt like we were going to get some indication or there was the potential to get some indication of what was happening with regards to negative interest rates, but also details around the introduction of a new concept for for the New Zealand and Monetary Policy Management. This was the Funding for Lending program, or the FLIP as it's being referred to. So effectively we got details on the FLIP, and what the FLIP is going to do is the Reserve Bank is going to lend directly to the settlement banks. They're going to lend to them at basically the official cash rate. That window, that borrowing, that will be operational for around 3 years, and it will be a floating interest rate. Now, what they're trying to do there is they're trying to ensure that retail interest rates benefit from the effect of what we've seen of lower wholesale rates. In addition to that, they've still got the QE program going, and in addition to that, we've got a very low official cash rate. Some of you will say, why have interest rates sparked up like they have? Well, the interesting thing is that the markets are now starting to, I suppose, not quite believe that the Reserve Bank is going to be able to maintain their position that they've got. So the Reserve Bank in a very difficult position at the moment. You must remember that the Reserve Bank have a very clear mandate under their policy targets agreement. They're mandated to maintain consumer price inflation between 1% and 3%. So you've got a midpoint there of 2%. They've also got to ensure that they promote maximum sustainable employment. So they have a dual mandate, employment and CPI, and at the same time they've got to ensure that they monitor financial stability. And what we've seen is we've seen this sharp run up in house prices lately, a very sharp run in house prices, and we should point out that it was not anticipated at all, not only by a lot of bank economists, but also by Treasury and the Reserve Bank forecast. They all actually saw house prices actually falling, not the sharp rise that we've seen. So that's a result of many factors, really. It's a result of undersupply in the housing market. It's a result of the removal of the loan to valuation ratios, very low interest rates. Sort of people don't want to leave their money in term deposits. And of course, that very low interest rates means it's cheap for people to borrow. You can go out and borrow money at 2.5%, even lower, I think, 2.3%, 2.4%, which is kind of crazy if you think about it in historic terms. But there was no mention of negative interest rates, or very little mention of negative interest rates in the monetary policy statement. And also, the market is now starting to think that maybe in their relentless pursuit of a little bit of inflation and ensuring maximum sustainable employment, that they're going to get behind the curve, and the market's going to heat up. Inflation is going to heat up a little bit, and they're going to have to reverse their direction at some point. So prior to the monetary policy statement, built in to a lot of interest rates were expectations of a negative official cash rate at some stage in 2021. Right now, if you look at the pricing in the interest rate curve, there is no pricing of negative interest rates in 2020. And I suppose that those of us with very long memories can think back to 1994 when we saw quite a significant bear market in interest rates. I'm not suggesting that that is going to happen in 2021, but certainly there is a fear now that the Reserve Bank may get a little bit behind the curve, as we say. The other issues around that are, of course, if they do change their bias, then there's potential for the currency to go quite a bit higher. Currency is already higher than where the Reserve Bank has forecast it to be. They look at the TWI, they're forecasting a TWI at 71.5. It's currently well over 73 cents. So what happens on interest rates is going to be very interesting. And remember, what we see when we talk about interest rates, we've now actually got to talk about all the different sorts of interest rates. So what's happening on retail rates, what's happening on wholesale rates, what's happening on mortgage rates, what's happening on term deposit rates. So there could be many different themes floating through 2021. And just to show that this is not only happening in New Zealand, it's happening in the US as well. That's the US 10-year Treasury bond, and as you can see, hit a low just around 0.5% earlier on this year, and has climbed quite a lot and actually almost hit 1% recently. So we're seeing global rise in interest rates as well. So after all that, where are share markets right now? Well, they're hitting all-time highs in the US. Valuations, we like to look at valuations. They do continue to be stretched, but of course there is a big question mark over where is the right place for valuations, given that we're in an unusual interest rate situation. New Zealand share market has held up better than other developed markets. But now, right now, you're in a very tricky situation because there are a number of competing factors. We've got these medium-term factors which seem quite constructive for equity markets, particularly if we get a vaccine, we can all get back to traveling, we can all get back to going out more, we can all get back to spending, everybody can get back to putting together trade deals. But once a vaccine has been not only proven but also distributed and has been administered, so that's the medium term. But short term, right now, we're seeing a significant worsening in the virus situation. And if you had just landed from Mars and had a look at the numbers right now, you would, particularly in the US, you would be extremely concerned about the potential for an exponential explosion in cases in the US. I'm not suggesting that will happen, but certainly this second wave seems to be, we're seeing peaks in places far higher than we saw earlier on this year. We're seeing this in parts of Europe as well. We're also got to try and figure out what happens about the role of central banks and interest rates going forward. We're seeing some rotation at the moment out of those growth assets into the value and the cyclicals. We are waiting the outcome of the US election. I think I'm pretty sure where it's going to go, but there seems to be one guy that doesn't want to accept that. And don't forget, in the background, we've got Brexit. They've got till December the 31st, and we're getting that sort of brinksmanship coming into play at the moment as well. Just a quick note on valuation. You say you're worried about valuations, Andrew. I say, well, yeah, I am a little bit. This is the forward PE ratio for the S&P 500 going back to 2006. As you can see, it fell off quite sharply in the middle of peak despair on coronavirus, but it's strongly recovered. Big question mark when you look at the forward PE is where are earnings going to be? Where are earnings going to be? Well, you know, it could be a lot of question marks over how quickly do we get these vaccines out? How quickly do we see economic recovery? That's back to 2006, the forward PE. If I look at it on a slightly longer term basis and say, yes, well, we're back at 22.1 forward PE on the S&P 500. Historically, we've been there before. You know, it stayed up there and quite strongly up there through 97, 98, 99. And of course, we saw a peak prior to 2008, leading 2007, 2008. But just remember, there is this question of where should PEs be when we're in this extremely low interest rate environment. So you've got that terrible question that we always ask ourselves, is it different this time? And the answer to that at the moment is we're not entirely sure, but certainly where valuations are at the moment, we believe they are a little bit stretched. Doesn't mean they can't stay up here, but certainly it's something you've got to be aware of. Just want to talk a little bit about central banks and interest rates, because I can hear people responding out there saying, hey, Andrew, what about these interest rates? They're going up. Isn't that negative for markets? Well, it just depends on how far they do actually go. I mean, if we do see rates go up from here, they could still actually remain at historic lows, even if they're not at the crazy lows or even potentially negative rates that we thought we were going to see. So that TINA principle comes into play or remains in play. So there is no alternative. So even if we see no need for negative interest rates in New Zealand, for instance, that doesn't mean to say that retail term deposit rates are going to go anywhere, particularly if the Reserve Bank is keeping the market flush with funds through the FLP. We could see term deposit rates remain quite depressed, even if we're seeing wholesale rates moving a little bit higher. So we know the central banks are going to remain accommodative, but equity markets will be sensitive to any change in bias. So that's what we've got to see. We've got to see whether or not we see a change in bias through the central banks. We do know that returns from fixed interest will continue to be reasonably depressed. I mean, even if rates don't go up a heck of a lot, you know, so we don't see negative returns on bond rates, but even at the low rates they're at, you're going to see fairly low returns from that fixed interest sector, which is going to continue to make other asset classes look attractive. The other thing I wanted to talk about was the very interesting things we saw post that announcement that Pfizer had a vaccine which they tested on, I think, 43,000 people, proved to be very effective. I think they've just revised up the efficacy numbers on that, and we've had further announcements since then. Moderna, I think there's another one of the other vaccine trials have had numbers out as well. So it looks very much like we will get a vaccine at some stage. So we're seeing significant flows into equity funds, and that's been quite a sharp turnaround. Now, sometimes people will say, well, heck, they're so pro-cyclical of those retail flows, isn't that time to get worried? Well, yes, but those flows will have an effect in the short term. But one of the things we instantly saw when we got that vaccine news was this growth versus value rotation. So growth stocks had been at the forefront, everybody had to buy growth, value had underperformed. Then we saw this switch around. We saw cyclicals coming back into favor again. We saw some of those growth techie stocks come under a little bit of pressure. We saw the stay-at-home stocks go out of favor. Crazy companies like Peloton, which was doing, in-the-home cycling, they, very popular through lockdown. We saw some stocks like that get knocked back. But this is the key issue that I'm grappling with in the very short term. Will this short-term coronavirus situation that we're seeing overwhelm some of these medium-term factors? And we just have to see how this plays out over the next few days. But I mean, we've seen 100, and I think yesterday 175, 180,000 new cases in the US. So they've got a significant problem there that's growing. Unless they get hold of it, you get this issue of it becoming, as I say, exponential. Look, just for the last 10 minutes or so, I do want to talk about the select model portfolios. I've put some of the performances up here. The one thing I do want to talk about or highlight is the fact that we had been reasonably pleased with performances from the model portfolios, but we have had some challenges recently with the balanced portfolio. So I just want to run through how the portfolios are positioned and what we're doing in terms of addressing that performance issue, particularly in the balanced portfolio, and how we're placing the portfolios. But we made changes to the portfolios quite a few months ago, back in September, and the changes that we made, I think all made sense, and they probably have been contributed to positive performance. So I'd like to think the changes that we made, we would have seen benefits from through this sort of late October, early November movement we see in the market. But most of the portfolios are now placed with an overweight exposure to growth assets. The conservative portfolio, the strategic asset class setting is 75-25 income to growth. We're currently 70% exposed to income and 30% exposed to growth. We actually can't put any more growth assets into that conservative portfolio before going over some of our DIMS limits. So that portfolio is placed as growthy as we can be in a conservative portfolio. The balanced portfolio also has, and this was done, as I say, several months ago, back in September, we also overweighted the growth assets. We did the same thing in the balanced portfolio, in the growth, and in the high growth portfolio, well, it's 95%, and that's a neutral positioning, but it's got, as you can see, very little exposure to income assets anyway. But there's some fairly significant differences there. The balanced portfolio now 8%, or has been since September, more than 8% overexposed to growth assets, and we would like to think that we'll start to see that the effects of that coming through in the performance outcomes as we've seen markets carry on up to, as I say, to recent all-time highs. So the key points for clients in terms of the portfolio bias from the changes that we did back in September is we increased exposure to growth assets, we reduced the exposure to fixed interest, and we were either holding or had increased a reasonably aggressive position in property. So if you look at the conservative portfolio, the tactical exposures, it's a maximum exposure to growth assets, but we have had an underperformance at the asset level. So I felt we made some good decisions in the asset allocation strategy. We've been let down a little bit by some of the performances at the actual asset position. One positive contributor to the portfolio, we had 10% exposure to property, 5% is the strategic asset allocation, so there's a fairly material overexposure to property. In the 3 months, that was up 11.6%, was the asset that we used in there. So that was a strong contributor to performance, but some of the Australasian equity selections underperformed, and the global equity selections underperformed as well. We removed REC Capital from the portfolio. It had been a detractor on performance. We also have exposure to infrastructure. And infrastructure, even though I felt it was the right place to be, when we were in there has underperformed where equity markets have gone. And back in September, we took Magellan Infrastructure out of the portfolio. Those global equity selections that we have, they will have benefited from the rotation to sort of value cyclical that we've seen since the end of October. The conservative balanced portfolio, again, we also increased growth assets, tactically short income assets. Again, you have that strong contribution from a strong overweight to property, but the issues around Australasian and equity selections. Rick Capital, we also took out of the portfolio, will also have benefited from the rotation to value cyclical assets. We retained the exposure to Magellan Infrastructure, and that will have been a drag on performance. Now, my problem child, the balanced portfolio. We retained Magellan Infrastructure and Rick Capital only at 3% in the portfolio, but it has held the portfolio back. But again, it's got a strong exposure to property as a balanced portfolio, and that has been a positive contributor. As I say, we would have expected. I'm going to talk very shortly about what we're thinking about doing in the portfolios in the next couple of weeks when we make the next big changes, but we will be looking very hard and closely at some of those Australasian equity and global equity assets. The balanced portfolio, so say from a performance perspective, it has been disappointing. Key reasons were the very material underperformance of RIT. The growth assets have underperformed Australasia Global, but in the last 3 months, the portfolio has been significantly underweight income assets, which would have been a positive, and it's been overweight property, which would have been a positive. Growth and high growth, the main points to open there, note in the growth, we were overweight exposure to property. High growth, we have neutral asset class positioning. So we're coming up to the December rebalancing, and when we make we are going to probably make some significant changes to the portfolio. So there's a couple of things I do want you to note. I do want you to know that we are thinking about. We're giving a great deal of thought to the domestic versus offshore exposure on fixed interest or exposure to credit in the environment where we've either got rates very low or potentially going up. We have to ask what we want our duration position to be, and do we want exposure to duration or exposure to credit? We're also taking a fairly material look at the particular manager representation within the portfolios. Those of you will be aware there's been a lot of announcements recently around some of the large managers that we have in the portfolios. We will be taking that into account. We'll be reviewing the property exposure. As I've said, we're very long, very overweight exposure to property. Do we want to retain that? Do we want to retain the infrastructure exposure? And we'll be contemplating the style bias that we have in the equity selections. I mean, clearly, having exposure to value stocks over 2020 has not to date been the best place to be in comparison to growth. Now we're starting to see a little bit of a change in that. We've got to ask, how do we want to be placed going forward? So where to from here? Well, I've talked about these short-term versus medium-term forces at play in the short term. We'd like to think that we're going to see an orderly change in US administration. That does look like it's going to happen. We've got to keep our eye on this acceleration of second wave of coronavirus cases. And just in case any of you have forgotten, we've got blooming Brexit still bubbling there in the background. Hopefully that won't cause any problems. Medium term though, we've got the impact of the vaccine being rolled out. Have to ask the question, has that already been priced in? And have people thought about the implications of actually delivering these vaccines around the world and getting them where they need to be so that we can start opening the world up again? Underlying stimulus and monetary policy support are constructive for equity markets. And New Zealand may be an outlier in terms of the economic landscape. And I say that because we are starting to see the New Zealand economy sort of look remarkably resilient compared to other economies, and whether or not that is actually going to have to prompt a change in the monetary policy positioning. Those are the questions we're asking ourselves. So we're about half an hour, which is always a little bit longer than I thought we were going to be. Feel free to fire any questions through you have. One thing I did want to talk about is I did just want to mention the Select KiwiSaver. Select KiwiSaver, very exciting development for us. It goes live next week. I'd encourage you to talk to Tahana if you've got any questions, or Helen. Exciting new initiative for us. We're looking forward to seeing how that goes. And if you do want more information, give Tahana a call. I'm hoping that I'm going to catch up with a lot of you in the road shows when we trot around the country in December, where maybe we can share a beverage or a cup of tea and have a chat and talk about a year that many of us are unlikely to forget, and look forward to 2021. With that in mind, enjoy the rest of your day. Have a great weekend, and I'll see you in December.